Thank you for joining the Advo-Cator podcast. Today we are joined by Jared Antin. He is an executive director at Brown Harris Stevens, where he drives strategic growth and agent performance at one of the nation's most respected real estate firms. With nearly 2 decades of experience, spanning from brokerage to development and leadership, he has built his career from a top producing agent to a senior executive. He's known for his collaborative leadership style and has been recognized by one of Crain's New York businesses' rising stars in real estate. Jared is passionate about developing talent, strengthening teams, and helping folks adapt to the evolving real estate landscape. There's a tremendous amount of value in today's episode. Thank you for joining us, and let's get to it. Jared, thank you for joining the Advo-Cator podcast.
Happy to be here. Thank you.
Happy to talk today. New York City is a market we spend a lot of time in. Our clients and our listeners spend a lot of time in, and people are wondering, with the market that we're in today, with the environment that we're in today, what's going on in New York City? Is New York City real estate dead or what?
Well, we're definitely not dead. We might be frozen temperature-wise, but not market conditions. We did obviously have an incredibly snowy and cold start to this year, but our market is anything but dead. I had just written our February market update looking at what was going on in Manhattan based upon the January stats, and transaction volumes were relatively normal. We were right around the 10-year average in terms of the median level of contract activity, and that's encouraging. So things are moving, and we're sitting at about a decade low supply. So there's not a ton of things on the market, which is really starting to make the market feel more competitive in certain segments.
Yeah, I mean, you mentioned the low inventory, and for many years now, but we'll say, give or take COVID time, right? All of a sudden there was people going and wanting to go maybe a little more than usual to other parts of the country. If it was Texas, if it was Florida, if it was Tennessee, if it was South Carolina, going someplace warm when you could, when the world was remote, right? South Florida, going to Florida versus the Northeast, what have you seen in terms of, is it from your vantage point, is it actually cheaper? What is kind of the feedback that your buyers and your clients are kind of talking about relative to that type of migration?
Yeah, so the migration patterns are so different today than they were, in the early days of COVID. So it untethered people from their place of employment for really the first time for some ever. So it allowed people to be able to make a choice to be able to move to a warmer climate, a more affordable place, better quality of living. If you couldn't enjoy what makes New York, New York at that time, why were people paying a premium to live in a place that wasn't, firing on all cylinders? And this is why you saw so much appreciation in Florida and the Sunbelt markets, because people moved there and it far exceeded the available supply or how quickly they could build more housing. So you had this unstable, surge in pricings that went on, and many of those markets are now correcting. Interestingly, New York is not correcting because we never saw that same surge. We started charting upwards. So we've also had around a decade of flat prices, and we're now standing about 3 to 5% higher on a price per square foot basis than our previous peak was for Manhattan condos in 2016. And we're getting ready for our next sort of wave of a price appreciation in our market. But New York is a transient place by definition. A lot of people come in, a lot of people come out. About 65 to 66% of our housing stock is actually for rent. So there's a lot of people that are continually moving. When you look at where people are going today, if people are leaving New York, they're generally leaving to go to the tri-state area. That means that they're not leaving their commitment to the New York City region, but that they're moving out of the city like many people have for decades before, based upon life needs. Either they have a growing family, or for some other reason, they want to move beyond the type of real estate or the lifestyle that New York City offers. And behind them comes a whole new sort of flow of people. While we are still seeing people go to other states, that flow has slowed down a bit. And we're not seeing that people's commitment to New York City has changed. What has changed, though, is that it's not New York or nowhere. It's New York and probably 1 or 2 other places. So we still have people who want to own a piece of New York and want to be here, but they may also own, a place elsewhere, multiple places elsewhere too.
So does that venture to say that New York owners are really more seeing it as and maybe they've always seen it that way. Maybe not necessarily a place to live, more a place to have a stable investment that they can kind of dabble in when it fits their lifestyle.
Yeah, I think, for many right now, New York is a discretionary purchase. And this is evidenced by seeing that the luxury market, and we'll talk about this more in a couple of minutes, the luxury market has really fueled a lot of the transaction volume and has been performing above long-term average. And when I say luxury, I mean the $4 million and up, whereas the under $4 million market has been at or, below the long-term average in terms of transaction volume. So high-end consumers, those that have the disposable income, want to be able to purchase and own a piece of New York because they want to enjoy what it has to offer. And we're seeing those buyers, remain incredibly active in our market.
So it seems like inventories are low. So do you espouse that to less folks willing to enter the market with their property? Or do you see that as soon as they come on, they're going for the most part in the high-end residential area?
So I've long said, and this is the continuation from your last question, it'll bleed into the answer of this, that New York City is like a blue chip stock or a blue chip investment. It's not like other markets that'll rapidly rise or fall like Bitcoin or a technology stock. New York City is generally marked steadily higher over the long term. Now, as I mentioned, we had this prolonged period of price stagnation, but importantly, we did not really see prices decline over that period of time. Yes, there were ups and downs in there, but zooming out, it's been largely flat. So New York has generally been seen as a more stable investment, a better store of value. And because of that, we're seeing that people don't sell or, flee New York in times of chaos or in times of confusion. And we tested this after 9/11, the 2008 Great Recession, COVID, and now again, too, in times of uncertainty or if a market's not doing incredibly well, sellers just won't sell because we don't have as high of a financing amount, meaning there's a ton of all cash buyers, and the purchasers that do buy here are generally only financing up to 80%. So there's a larger share of having equity in their properties, and they're not quick to just sell when something goes wrong. They will generally hold. So the fact that we had nearly a decade low supply this past December, we did hit a 10-year low in our inventory, speaks to the fact that people are confident in New York. There's not fear or concern. People aren't trying to get out. They're just sitting still and holding tight. And that's why we're starting to see the market get a bit more competitive.
Thank you for joining the Advo-Cator podcast. Stay tuned for more from Jared Antin from Brown Harris Stevens. Here, we're talking about the New York City residential inventory and how they are at historic lows and why. We're also talking about how 2025 fourth quarter had the third most transactions ever and what that means. We're also looking at how high-end real estate in general as a market is booming, and for high-end construction, service, and other related contractors and service companies will be needed and why. Please enjoy this episode of the Advo-Cator podcast. If my business or the support of my business is on the food chain of transactions, but people are not necessarily abandoning their investments in New York, right? 10-year, you said, low inventory. Do you think that if we're trying to forecast a little bit here, we're always going to have folks that really feel like it's a good investment to kind of be and stay in New York, regardless of how you might use the the space on a long-term basis? But are you seeing a similar type of transaction history, in terms of transactions on maybe the last quarter and then kind of forecasted for the next quarter as we start to get to a busier time of year for, forget the holiday season, but are you seeing a normal amount of transactions, more transactions, or less?
We're seeing the easiest answer is we're seeing about a normal amount of transactions. This past December, though, was the third best December in the last 9 years, only behind 2021 and 2022 there. So, or 2020 and 2021. So we obviously had the boom years of the low interest rates, the pandemic fueled demand, and then we had the volume trap when interest rates rapidly rose. But we're coming back to the sense of normalcy because interest rates have come down about a point from their highs based upon what the expectations are for the Fed and their rate cutting campaign. Interest rates are probably where they are, with very little moderation for the next 12 to 18 months. So there hasn't been this push or pull recently. In the early days of COVID, it pulled forward a lot of demand. When the rate spiked, it pushed out the demand. And now we're seeing people are transacting based upon their life needs.
Yeah.
They have a new baby, they got married, they got divorced, there's a death, whatever it is. There's something that they're going to transact because they need to do it. And they're not really motivated by those external pieces, more those intrinsic factors that is really motivating. So that's how we've seen a little bit of a difference here. And I do believe we are on a upward trajectory in terms of the amount of supply, or sorry, the amount of demand that our market's going to see. And really how competitive this spring gets is going to be based upon how much new supply does come on the market. We're gearing up for a spring market, which traditionally runs from middle of March until Memorial Day. So it's going to depend on how much new supply comes on and how quickly buyers are snapping that up and purchasing that property to see really where the leverage shakes out.
So, I mean, not to summarize, but effectively, inventory is low.
Mm-hmm.
Transactions are roughly normal.
Correct.
Right? Which one might think that it might not be the case, given some of the turmoil that people might be reading about or thinking about. Right? So transactions are normal. Inventory is low. Values are holding.
Mm-hmm.
It's still effectively an investment. However, most of the city is still rental, which also means that it opens the door for future investments for other reasons, in terms of how you utilize the property.
Mm-hmm.
If you're not going to utilize it for yourself, and if you're going to want to live in
a
other
condo,
places.
yeah.
So ultimately, in a lot of ways, the New York City market feels strong. It feels normal in terms of average. Things are moving. They're moving for the right reasons. So maybe some of the sentiment is maybe conjecture, but nonetheless, the market is still strong in your assessment.
Correct. Yeah. Now, there's definitely a majority of the demand going after a minority of the supply. Properties need to be priced correctly. They need to be turnkey, beautifully renovated, properly proportioned. So you can't have too big or too small of a space for relative to the bedroom size. And they have to be in good locations, in good neighborhoods. Those properties, those sellers have a little bit of pricing power and are trading really, really well. But buyers are still a little bit punishing, obviously, overpriced properties or those that require some work. Buyers are still fearful of overpaying. They're incredibly well educated, and they're also patient. So sellers, who have the best properties see that momentum, and otherwise you have to make sure they're priced correctly.
So I think if you're looking at it from a market perspective, and you're sitting there saying, okay, so New York City market is strong.
Mm-hmm.
Yes, people want to live other places, and that's always been the case, right? If
they're entitled,
of course. If it's the tri-state area, if it's the suburbs or whatever it is, or if it's for those that can, go to other climates or whatever. Ultimately, the Northeast in general, New York City and New York area, and the tri-state area being one of them, seem to be still a very kind of strong investment in general, because if New York City is still strong, and then tri-state is strong because that's where people are going, in spite of it, you really, the Northeast is still a very strong investment. The question is, do you feel like you have that outflow to other parts of the country quite as much or on any level as it was? I mean, obviously it's not going to be COVID, but there was conjecture that, with the political environment, that everybody's going to leave the New York area. So what are you seeing? When transactions are happening, you're saying most folks are going to the suburbs, not necessarily relocating out of the area. Are you seeing most people staying in the Northeast, or are you still seeing that mix of going to warmer climates?
Yeah, I mean, the predominant of the moves that are done out of New York are staying within the tri-state area. While sure, people are going to move to other markets, and they always have. Yeah. That's not really the predominant, move right now. There was a lot of fear mongering around the, mayoral election and what was going to happen. And the reality is, if there was really a concern, we wouldn't have supply at a 10-year low rate right now. So everyone's not leaving. Again, people like it. They stay here. They're good to be here. And we're not really seeing that outflow. And part of this is, again, how our market moves a bit countercyclically to the national trends. And, the markets that were hot before that we talked about, like South Florida and across the Sun Belt in Austin, Texas, for instance, those markets are now fundamentally correcting as they have more supply than there are buyers interested, in part because the population outflow has stopped. And truthfully, I believe that even if we had a mild recession, just a mild one, but a mild recession could bode well for Metro New York because it'll bring more people back to employment centers, right? Employers have been trying to get employees back to the office with the RTO, and there's been various degrees of success of that. But if there was a mild recession, if the labor market did weaken, that would shift the balance again further from the employee back to the employer, which could require more people that have been able to untether from the employment centers to come back to them. And again, that could, help to some extent to support the real estate market here. And that's part of why, we move a bit countercyclical, because our client base is so large and so diverse, whether it's domestic, international investment, primary use, secondary use, there's a lot more variety here, which is helping to support, a more robust, more dynamic market.
And I mean, look, for the most part, you're seeing a lot of luxury over 4 million transactions. And this may not be something that comes up in the course of talking about those types of transactions, but I'm curious from an employment kind of style. I mean, I have my own opinion and kind of what I hear, but are you hearing more migration back into the office, or are you not hearing it at all? Like, do you have a read on what's kind of happening in the market relative to folks coming back into the office?
Yeah, it depends on the companies. I mean, I can tell you anecdotally, I commute in from Westchester, and starting January, the commuter parking lot was back to nearly pre-COVID levels. The trains felt fuller. So anecdotally, there was definitely more employers that required, people coming to the office. But every day is also a little bit different. Mondays are less busy. Fridays are, almost still like COVID times, because a lot of people do work from home. But Tuesdays and Thursdays are definitely the two busiest days that I noticed in terms of commuters coming in, followed by Wednesday, then Monday, then Friday. But I mean, we've seen demands come from people that, used to own a 3 or 4 bedroom in the city. At some point during COVID, they moved out, maybe beyond sort of daily commuting distance. And now they're looking to buy, a larger one or a more efficiently, sized 2 bedroom closer to where they work, just so they can hang their hat, 2 to 3 nights a week and not have to make the commute. So we're seeing some of that more than we're seeing sort of families that moved out looking to move the family back. Now they're trying to buy that pied-à-terre, or we're seeing people that are becoming empty nesters that may not want to sell their home in the suburb, dip their toe into owning something in the city. Again, now that New York is back to being New York and they can enjoy all of the, lifestyle and such, they want to be here and have a piece of it. So we're seeing that fuel some of the demand as well.
Okay. So then thinking about some of what you just mentioned, like, your boots are on the ground, your ear is to the ground, you hear what is out there. What is coming back to you from the buyers, the sellers, buyer sentiment, sellers' expectations? What are you hearing there? What are some of the challenges that they're facing? Just talk to me about, I guess, whatever buzz topics are kind of out and about right now.
Well, I think the important thing is broker sentiment is up. So Brown Harris Stevens has an open house index that's led by my colleague Sarah Rotter. And because we had 2 back-to-back weekends of snowstorms, we didn't really have open houses. So we conducted a broker sentiment survey. And 63% of the respondents said that the market is feeling busier to start 2026 than it was to end 2025. And I certainly feel that, and it's good to see that a lot of our industry feels that as well. Sellers are ready to be able to modify their expectations. They're becoming a little bit more realistic. And while, again, we've had less inventory come to market to start this year, about 9% new listings came to market, or 9% less new listings came to market this month than is normal, in part because, again, with the cold weather, with a lot of snow, it kept the sellers away. That's why we're going to see how much inventory comes on if or whenever the weather warms up. But that's going to be an important piece. But sellers are getting a little bit more realistic. And again, buyers are confident to some extent. Those that don't need to finance, those that are not worried about, their income. This is why we're seeing those discretionary buyers, the higher priced buyers, do a little bit better, because they're able to buy and they have the confidence, they have the means, and they're buying because it's emotional. They want it. It's different than needing it, we are seeing some buyers that need it or that need the financing. They're going to be a little bit more cautious. They want to make sure that their I's and T's are dotted and crossed really, really well. That's not to say they're not transacting, but they're transacting with a little bit more caution in the market and wanting to make sure that they're, seeing a lot of stuff. They're double and triple checking, and, they're focused on long-term holds and long-term value.
The Advocate Association. Calling all small and mid-sized businesses, the Advocate Association helps you cut costs, improve safety, and grow smarter. Through education, advocacy, and exclusive member benefits, please visit us at theadvocateassociation.org. Our members are saving on things like health insurance, auto insurance, workers' comp insurance, auto fleets, legal, accounting, software, IT services, building supplies, and more. Again, please visit us at theadvocateassociation.org to find out more and to join.
So I guess I'm a little jaded because I see a lot of, my world is risk, right? So I see a lot of claims related stuff. I see, losses. I see premiums. I hear challenges why insurance premiums go up and all that kinds of stuff. I wonder from your side of the desk, if you're thinking about the costs, the maybe the unforeseen costs of living or buying in New York City, what do you hear in terms of those types of challenges? Is it common charges? Is it reserve funds within buildings and condos and co-ops? Is it insurance premiums? Like, are there kind of the hidden costs that are either questions or then feedback post-transaction? I didn't expect this. So what are the customers giving you feedback on?
Yeah, I think the most salient points that clients are looking at is like, what's the total cost that it's going to cost me every month? But they don't look at insurance, right? So they're going to look at the price and they're going to understand, okay, if I'm financing at this rate, this is the type of mortgage, this is what my payment's going to be, and then what my common charges and real estate taxes are, or my maintenance is. That's really what they're hyper fixated on. Obviously, if there's an assessment or something like that, that comes up. But there's an inverse relationship between carrying costs and price, right? If something costs you more every month in real estate taxes or maintenance or common charges, the corresponding value of that property is going to be lower, right? And the inverse is true. So that's really what people are focused on. I don't really encounter clients, getting the quotes on what the insurance is until later. It's almost like buying a car, right? The first time you understand usually how much your insurance is going to be is after you sign the paperwork, and now you got to go and get the insurance binder for the dealer. So it is a real cost, but it's not as sort of high of a cost that people are looking at in that same way. Although, some savvy consumers will focus on that. But I think because we're not really in as much of the flood zones or have some of that issues, because you're just buying that walls in or HO6 policy, it's a little bit of a different thing.
Yeah, and for the most part, you're right. I mean, generally, insurance for consumers, individuals, personal, it's somewhat community rated. So the carriers really will rate a risk based almost on the zip code, and they're just expecting like, well, not everybody in the zip code is going to have the same experience. So in aggregate, if we have one or two, it doesn't spoil the whole bunch because we have a bunch of others that didn't. What I have seen in, over the last, 3-4 years is the increase in cost to HOAs for their coverage for effectively the common areas, the exterior of the building. And that's been one that's come up a lot. I've met with a lot of, boards, a lot of investors where they're really talking about, ways to control that cost. But again, it's really spread out among all the units. Right. And so even if there is somewhat of a 10, 15, 20, 30%, whatever it is, increase, it's then spread out, and it's not necessarily such sticker shock as it might be if it was, specifically for you. There's nowhere else for the cost to be spread.
Right.
So I'm curious to see that because, your side of the desk, you're talking to the customer. My side of the desk, I'm speaking to the boards. I'm speaking to those folks, and I'm hearing like, how could insurance go up or whatever it is? And it's interesting to hear from a customer standpoint because of the splits of 60 units, 80 units. It's not a focal point.
But it comes through when when the owner gets their annual common charge or maintenance increase, right? And that increase is based upon insurance, sure, any sort of underwriting on the mortgage that the building may have, staff, taxes, things like that. So we have seen higher than normal year-over-year increases in maintenance of late. I would argue that 2 years ago, the increases were generally higher on average than they are today, but they're still higher than they traditionally have been.
Yeah. This break is sponsored by Advo-Cator Risk Management. Running a business comes with risks, but you don't have to face it alone. At Advo-Cator Risk Management, we specialize in tailored risk management solutions that help you protect what matters most and lower your risk costs. Things like insurance and deductibles. We have saved our clients millions in industries like construction and real estate, transportation, healthcare, service companies, and more. Our team helps you navigate challenges by reducing exposures and having custom solutions for your business. From coverage audits to proactive safety strategies, we go beyond policies and become your partner in protection. Don't wait for crisis to find the right support. Visit us at navigatorrisk.com and take control of your.
The big picture that I'm getting, from you, if I was to, put a bow on a little bit of this is, New York City market is strong, Northeast market is strong still. There's always going to be the outflow to the warmer weather, but at the end of the day, there's, the Northeast or New York is still what it's always has been. It's just evolving like every other part of life.
Correct.
And really, the luxury market continues to be the strongest part of the market. And so, if you have a business that services the luxury market in the New York City or the tri-state area, you should feel good that the market's strong, the transactions are strong, your customer base is strong. And that says a lot, because if you think about what makes this area tick, it's not, there's tourism, there's built-in transactions, but the core of this community of the Northeast and of the New York City area are the people that service it.
Right. And
if there is nothing to service, then the outlook doesn't look so good, right? So
true.
you might not be a real estate agent and feeling confident about transactions. You just might be a service company.
Right.
You might be somebody who services a building or customers or whatever. Or on the flip side, you might be somebody who's looking, if you're looking to invest in, or you're looking to expand your portfolio in the Northeast or in the New York City area, you want to know that these are the things that are going on. The buyers are there. The market is strong. And that's kind of the gist of what I'm hearing from you today, which is exceptionally helpful. Anything else? Anything else top of mind that I didn't get a chance to get to?
Well, I think it's important just to keep in mind how counter-cyclical, New York City and Manhattan is to that national market. And it's for a number of reasons that we talked about today. But I think it's very interesting to see, that the markets that are doing really, really well today, that we talked about the Northeast, we talked about, or, the Midwest as well, and California are some of the markets that struggled before, right? And, the Northeast is doing well because we maintain this supply-constrained market, the tri-state area. We didn't have a lot of people that left. We still had some people that wanted to buy. It's shocking that, even though interest rates rose drastically, the prices still can go up. And in certain markets, that's true because supply shrank way more than demand, was reduced. And that age-old economics still hold true, the ratio between supply and demand. You've seen upstate New York do really, really well with Buffalo, Syracuse, Rochester markets, some of the best performing markets in the country. You've had the Midwest doing really well across some parts of Indiana, down through like St. Louis. This is because buyers are seeking more affordable options. So they're able to buy decent houses for $300,000-$400,000. And then parts of California have been doing well too, as this whole AI boom has sort of rejuvenated Silicon Valley as well. So, it's interesting to see the full turn, as we're coming now 6 years out of COVID. I think the other really interesting thing that I'm looking at in New York City is our holding periods are shorter than normal, right? Usually people are taking a 30-year fixed rate, they're holding and owning the property for 10, 12 years. In New York City though, sure, there's a high degree of cash buyers, but those that are financing are more likely here than elsewhere to take a adjustable rate mortgage because their holding periods are shorter, generally between 4 to 5 or 6 to 7 years, depending on if it's a condo or a co-op. So that means a lot of buyers will take a 5 or 7 year ARM because they don't expect it to own it beyond the ARM, and because you get a bit better of a mortgage rate. So the people who bought in the early days of COVID, we're now coming up to 5.5, 6 years on that. The 5-year ARMs have expired or just expiring, and the 7-year ARMs are going to soon expire, which means they're going to reset to the current rate. So part of the reason that people have been hesitant to move is that lock-in effect, right? The difference between the currently available rate in the market and their interest rate is so large that it's almost unaffordable for them to move.
Right.
But as these ARMs come due, and the people that bought in the early days of COVID here are generally sitting on some equity. So they'll be able to trade up, make a little bit of money, move into a new rate. And that's going to be really important to get more of the engines of the local market moving, where you have motivated sellers that then become motivated buyers. And that's really what I'm looking to see come into the market really over the next 6 to 18 months.
So if you're someone sitting on, an apartment and you're thinking, is this the time for me to make a transaction? Like, I guess that's a lot of what's going into it, right?
Yeah.
It's like, are you technically a luxury apartment, or are you not? Are your costs have they been kind of stable? Have you not had any crazy assessments because there was, repairs or whatever needed to the building with the infrastructure? And then the third thing is, your financial position and if you were financing, when you got it and when is your arm up. So it sounds like those are the things that are kind of in sellers' minds.
Correct.
Of whether this is the time to sell. But what you're not going to be talking about is the market's not strong.
Right.
You're not going to be talking about any of that other stuff. That's all strong.
Correct.
Now it's just a function of
is it right for you?
What's the right time?
Yeah, exactly. Yeah. And that's like, if I'm telling a buyer, I'd say this spring is a great time to buy. The market's starting to get busier. Get in now. If I'm talking to a seller, sure, if they have motivation or reason to sell, we can position their home for success this spring. But if they ask me, I'm not pressed for time, I don't need to sell soon, like, if you can wave your magic wand and tell me when is the best time to sell, I'll generally say, if you can wait 6 months or wait another year, they may do better because the market strength will compound. So my advice is a little bit different. Buyers get in soon because I think the market's going to get competitive and we will start seeing price increase in due time. And for sellers, if you don't need to sell today, maybe wait a little bit longer because everything I just said is going to benefit you then.
Interesting. Yeah, well, you kind of have a lot of hungry buyers who weren't able to find in the first pass.
Correct.
And now they're in the second pass.
Right.
Yeah, I've experienced that personally, so I know exactly what you mean. Well, this is a great look. If I'm a business owner in the New York area, if I service the New York area, or if I want to invest or I'm interested about portfolios in the New York area, this snapshot makes me feel incredibly different about what you may not have known. And it's very helpful to have a perspective from that boots on the ground, ear to the ground kind of sound, because you really get a sense of what's actually happening, just based on what your customers and what your buyers and sellers are saying. Because ultimately, if you hear it enough times, you know it's not a one-off, it's not an article, it's not a soundbite, it's actually a commonality, and that's when you really got to listen to that. So it's very helpful for those that aren't that close to the transactions the way you are, to kind of hear what you're feeling underneath your feet.
And if you want to follow it every week, if you go to my LinkedIn, Jared Antin, and you can subscribe to my newsletter. I write a weekly market update. I'm going on 310 weeks now that I've written this consistently for Manhattan and Brooklyn, all trying to just break down what's happening locally in very much a so what. What is the data, what's the context, and what's the strategy for buyers and sellers in the market today.
Well, that's really helpful. We'll make sure we plug that, and really appreciate you taking the time, sharing all that Brown Harris and you, Jared, have to offer to all those that are thinking about what's going on in the New York, the Northeast, and really across the country, real estate wise. So thank you for the time.
Thank you for having me. Happy to be here,
brother.
Thank you.